On this episode, we have a awesome guest. Your co-host and host is Asif Kwamar and Herb Culp. Our very special guest is Steve Davis. And let me introduce our guest. Steve is a host of Total Wealth Academy radio show, heard 7 days a week across the U.S. And a little background: after receiving a Navy ROTC scholarship to Texas A&M and serving in the Marines, Steve quit his college to run a hamburger delivery business with a friend. Unable to meet their financial goals after 2 years, they quit and went into corporate America. After working 60 hours a week for 5 years, winning a national sales contest and a trip to Hawaii, his company cut his pay by $20,000 a year. So at age 27, with bad credit, no money, Steve quit corporate America and started investing in real estate. He was eventually invested in over 4,000 apartment units. For the last 30 years, Steve has helped teach and coach tens of thousands of people on how to use real estate to build wealth and passive income while focusing on maintaining a balanced life. He did this through his daily radio show and one-on-one coaching. He now owns his own coaching and consulting business, Total Wealth Academy, where he consults full-time. This program takes people by the hand and step by step through the real estate investing process. The education covers everything from single-family homes, apartments, self-storage, senior living, and more. Steve teaches his students how to build a second stream of income that meets and exceeds all their wants and needs so that they can simply enjoy life more. Steve, if you wouldn't mind giving us a little more background on how you got started in apartment investing and how that looked.
Sure. What happened, it was really kind of by accident. I didn't have plans to buy an apartment at that time, but I had a bunch of single family homes in Houston, and I met a guy who had a little 10-unit down the street. And he said, I'm willing to sell it owner financed, which I needed. And I bought it. Well, I bought it kind of arrogantly. I thought, I can run 100 houses. I can run a 10-unit apartment. Apartments are totally different from single family. And I didn't do very well the first year. In fact, I got my butt kicked the first year, lost like 10 grand. But I kind of grasped it after the second year. But then I sold it for a good profit, $249,000 less than it was worth, because I didn't understand NOI. I didn't understand cap rates. I just sold it. I thought, hey, I'm selling it for more than I paid for it, so that's a win. But I goofed up and sold it for $249,000 less than it was worth. And that was my introduction to apartments. So I took a couple of courses, finally, which I should have done before I bought the apartment. Took a couple of courses on real estate that included apartment complexes and started buying everything I could get my hands on. 22 units, 23 units, 40 units, anything I could get, I would buy. But then a kid came up to me who was working for me, and he goes, why don't you give me some of your money and I'll go buy a big apartment complex? And it's a long story, but if you knew this kid, you knew it was a safe bet. And I said, oh, okay, let's go. 9 months later, he returned an 85% rate of return. 9 months. And I said, you know what? I'm selling all my single family. I'm selling all my little apartments, and I'm just going to passively invest in a big apartments. And I moved all my money into these big apartments, and that's how I ended up with 4,000 units. And it was life changing because oddly, Herb, I realized that I didn't like real estate. I didn't like managing it, owning it, dealing with it. I love to teach. And so now that all my income from my real estate was completely passive, I did nothing. It allowed me to open Total Wealth Academy and do what I love, which is teach. So it was really an amazing journey and not what I was expecting. Deepak Chopra talks about that in the 7 Spiritual Laws of Success. It's to detach yourself from any certain outcome. Be open to opportunities that may be in front of you that you don't recognize. And that was what happened. It was just phenomenal.
Steve, that's amazing. They say opportunities come from where we least expect them sometimes. And
yeah,
the kid you mentioned that helped you invest, right, in a different way.
Yeah, it was totally shocking when I got that return. And I was like, this is more than I'm making, and I'm doing all the work. In the passive deals, I did nothing.
So Steve, this is Asif Khabar. So what is your minimum return of investment as a passive investor?
Say that again, I'm sorry.
What is your minimum return of investment as a passive investor?
I've averaged over 22% in the 30 years, averaged over 22%. And some of them were way above 22. But the lowest I think I've ever done is 15.
Mm-hmm. And what was yours as a single family investor?
I was making about 15 to 20% as an active investor, but that was just the cash on cash. Back then, I wasn't smart enough to know what IRR was, and that I was making money off the principal pay down and so on. So it was very similar, but again, I was doing all the work. So when you take the value of your time out of it, it's not a 22% rate of return like passive investing is.
I agree. Definitely. You need to actively involve in the single family to manage each and every unit.
That's right.
Correct. So how do you feel to helping other people to get the financial freedom?
Oh, that's the best. I'll tell you a story, and I've been trying to tell this without getting choked up. But a lady came to me one day. I had talked her husband into buying a little 35 or 40 unit apartment that made him $4 or $5 grand a month, which was more than he was making at work. She comes to me and she's in tears, and she hands me a suicide note that her husband had written.
Wow.
She said he bought a gun. He was going to kill himself. Now that he owns the apartment and quit that job, he's happy. He sings in the shower. We make love again. She said, it's insane.
Wow.
I've never forgotten that, never will.
Oh, yeah. That's a big achievement. You save a life.
Yeah.
Right?
It's humbling,
yeah,
to say the least.
Yeah. So let me ask another question. How important is for the investor to learn multifamily investment strategies before investing as a passive investor or a co-GP?
I think, yeah, you hit the nail on the head, because there's so much to it. And our formal educational system, high school and college, doesn't teach people about net operating income or internal rates of return or equity multipliers or cap rates. There's just nothing in our educational system. So you have to go out and educate yourself. On my radio show, I call it increasing your financial IQ to a level where you fully understand what you're investing in. That's why I prefer sophisticated investors to, and remember, some accredited investors are sophisticated, but I don't like accredited investors that come to me and won't educate themselves. They say, no, I'm just going to give you my money. I don't like that. I want them to take some courses, understand what they're investing in, and be sophisticated as well. In fact, that's a requirement at Total Wealth Academy for all our investors. They've either got to be, they've all got to be sophisticated, even if they're accredited.
Good. So what do you guys teach to the student? If somebody wants to join you, exactly what they are going to get out from your teaching?
Well, what I have is a series of 14 classes. They're between 30 minutes and an hour that goes over underwriting, how to understand a private placement in memorandum, PPM, how to read an operating agreement, what to look for in the PowerPoint or deck, how to evaluate apartments, how to evaluate self-storage, how to evaluate senior living, RV parks, all of the classes that we're investing in. We've got classes on how to evaluate those deals.
Good, very good. Herb, do you have any question?
Oh, absolutely. Steve, I watch your show a lot too, your YouTube channel, and subscribe to it. It's just amazing content. And there's one that I wanted you to talk a little bit about. It's just amazing to see what the banks are doing with my money that is sitting in my account.
Yeah.
Would you share a little about that?
Yeah, this is one thing that people don't understand, again, because it's not taught. But people say, well, I'm a little bit leery of passive investing, or flat out, I'm afraid. Well, what they need to understand is they're passive investing whether they like it or not, just they're not getting the benefits. So when you put money in a bank or you pay your insurance premium, what do you think the banks and insurance companies are doing with your money? They're passively investing it in real estate. I talked to a lady the other day. She's placed either $1 billion or close to $1 billion. One placement was $200 million from a bank. And the bank bought a bunch of buildings. They're passive investing with your money, making 15% plus. And when you put your money in the bank, you're getting 1, 2, 3%. They're going and making 15. Why don't you cut out the middleman? Cut them out. Give Herb your money. He'll get you 15, 20% rate of return, just like the banks and the insurance companies are getting.
You're absolutely right.
And it's somehow all the deposits from you and I and all the other deposit holders in the bank all pool together, and they have hundreds of millions pooled. So why don't you take yours instead of leaving it there and invest in a solid, secure investment like apartments?
Yeah, and people will say, well, the banks, do they buy stocks? No. Do they buy gold and silver? No. Do they buy crypto? No. They're investing in real estate. And people need to understand that. And the reason the banks and insurance companies invest in real estate is because they make money in both the up and down markets with real estate, just like you and I do. So unlike speculating in the stock market, metals, or crypto, where when there's a down market, you simply lose money. You go back to 2007, let's say I was making 80, 90 grand a month. The market crashed. All my property values dropped 20, 30, 40%. Did I care? No, because the cash flow was still $80,000, $90,000 a month. And it also, I'm sorry, I'm kind of getting off track, but I want to get this idea out. It's allowing you to live in reality, because most people are kind of delusional. They're in the stock market, and when it goes up, they get excited and they think it's going to keep going up. But it doesn't. It's not if the stock market's going to crash, it's when. The good news, though, it's not if the stock market's going to recover, it's when. So it goes up and down. The stock market has crashed, you ready for this? 18 times in the last 100 years. 18 times, about every 6 years. Same thing with real estate. It goes up and down too. So you have to live in reality. It's going to go up and down. But if you've got cash flow like you are generating for your investors, it's about the same, even when the crash comes. So real estate is the safest investment. That's why the banks are doing it. That's why the insurance companies are doing it.
Yes, that's very valuable. And the thing that we do is we underwrite not only the deals that we invest in, but we underwrite the market, and we underwrite the specific location of this apartment deal that we're investing in. And we also underwrite our co-sponsors. If we have co-sponsors on the deal, we underwrite them thoroughly. We have a process that we go through to make sure that it's the safest investment possible. And
yeah, I think you better define underwriting, because not everybody knows that term. Underwriting is like vetting. You're going through and analyzing everything that can go wrong with the deal, everything that can go right with the deal, and making sure you're still going to be able to get it done and it's still going to work. Underwriting is the most important part of any transaction, especially real estate. When you, as you mentioned, you've got multiple stakeholders. You got your GPs, you've got your LPs, you've got your construction company, you've got your management company. You got to underwrite all of them.
Yeah, it's a big process.
Thank you, Steve. That was very thorough. Yes. Right. And we always have a exiting plan, right? In a few years, 3 to 5 to 7 years, we know what we'll do with the property and the expected value at that point. So, all righty.
Okay, so I have a last question. If I would like to ask you, for my investors, what is the best 3 advantages they will get to invest as a passive investor?
I'm going to have to ask you to ask me that one more time to make sure I understand.
What is the best 3 advantages?
Oh, 3 advantages.
Yes.
Oh, that's first off, every dollar that a person puts into a syndication, into a passive investment, is making them money 4 ways. You've got cash flow, equity buildup, appreciation, and in many cases, equity capture. We just did a deal, I want to say, where we picked up $2 million equity the day we closed the deal. So the members of the LPs, the passive investors, their $100,000 investment instantly went to $150,000, $175,000 instantly. The second advantage, I believe, is, and this is important to me especially, is that passive investing allows you to continue to focus on your career. It allows you to focus on your family, your fitness, your spirituality, because you're doing nothing. It's not something that consumes your time. And then third advantage, I think that's just going to have to be simply that real estate is the safest investment out there. Real estate accounts for 70% of the millionaires in the United States. And worldwide, it's 90%. Now, interesting point, go back 140 years to Andrew Carnegie. You know what Andrew Carnegie said 140 years ago? 90% of the millionaires did so by buying real estate. So it hasn't changed. It's brutally consistent.
That's amazing, Steve. And with people like you and I, we find the best places to invest in real estate, because not all real estate is as safe as the markets that we invest in. So that's a great.
Well, that brings up a point, Herb. REITs. I hate REITs. And I'll tell you why. They're flow investors. If they raise $8 billion, they're under pressure to buy real estate. Not like you, where you take your time, locate the right deal, turn it down, locate the next deal, turn it down, turn it down, turn it down, turn down 200 before you buy one. The REITs are not doing that. They're just going out and buying. We sold 4 self-storage complexes to a REIT 9 months after we bought it. They gave us $5 million more than what we paid for them in We weren't going to sell them. It was like you said, a 3, 5, 7-year plan. But how can you resist when there's a REIT at your front door going, we'll give you a bunch of money?
Right.
So the more investors that invest in REITs are just not getting the returns that they would as a passive investor. The next reason I don't like REITs is they're really incompetent. They came in and bought 100 houses at a time, ran them into the ground, and now they're selling them $10,000, $20,000 below what they paid for them. So REITs are a bad choice. Herb is the, sorry to be so blatant about it, I'd rather give you my money than any REIT on the planet.
I have lots of clients that talk about REITs, and so they can be good, but you're right. There's so much mass there that the profit is reduced.
Yeah, they make all their money up front on those fees, and they could really care less if it profits or not.
Right. There's too much cash flow in or capital to deploy out on properties. Right. So that's amazing, Steve. So great to have you on the show today. And please go and check out and subscribe to Total Wealth Academy on YouTube to hear updates. And we'll see you on the next show.